What is fiscal policy? So you might have heard about this term before, but what is it? So fiscal policy refers to what the government does with their spending and taxes. So this is, another sort of policy that's implemented in the economy. We have monetary policy, which you've learned about, what the central bank does with their interest rates, what they do with their bond purchases. Fiscal policy is just what the government does. So monetary, just think money supply, who controls the money supply? Central bank, of course. Fiscal, just think government. So what's what they do with their spending and taxes? They aim to help support the economy in times of weakness and slow down and the economy when it is overheating. When the economy is overheating with inflation above target, they will aim to reduce spending and increase taxes to slow down the economy. Think about it logically. If they spend less, maybe there's less money going to a certain sector. Therefore, maybe there's less inflationary pressures in that sector as well. When you see a tax hike or they raise taxes, that means there's less money going to your bank account. Therefore, less spending power and naturally you might spend slightly less than you would normally. Therefore, inflation gets pulled lower. So in overheating with inflation. And conversely, when an economy is weak with inflation below target, you would expect to see the government lower taxes. Obviously, lower taxes means there's more money into your bank account, therefore more money to spend, and increase spending to help the economy. So let's start off with government spending. So one tool a government will use in their fiscal policy is government spending. The government will aim to spend money on goods, services, and investments to fulfill public needs. There are many different avenues that they will go down to fund. So some examples include public goods and services. So this includes building infrastructure like roads, bridges, and public transport. This can also include spending on healthcare, police, and public jobs. So if they want to support the economy, for example, and they build more roads and bridges and they want to build more public transport, well, then there's going to be jobs there, isn't there? People need to build bridges, people need to build roads. So if there's funding more of that in terms of public goods and services, that means there's likely more jobs there, and that helps to support the economy. Social programs. This includes funds to support the most vulnerable in an economy, such as social housing. They may also help with unemployment benefits, housing, and welfare programs. Defense. As the name suggests, this is where the government will spend on military and intelligence agencies like the MI5 or the MI6 in the UK, for example. Debt servicing. So debt servicing is where the government funds the debt they have borrowed. And grants. This is spending towards specific industries or sectors. This is aimed to promote more jobs and business within the sector. So what we mean by that is, let's say they are seeing, hospitality, for example, as really weak in the economy at the moment. It's not generating as much as it should be. They're going to push more money into that sector to help drive that overall industry up. That means there's likely more, companies might be able to borrow more. They might get grants or money boosts, if you will, for being in that sector. Therefore, they might likely be able to spend more, hire more, for example, and this will naturally help drive up that sector or industry further. So taxes are another primary tool in which the government will look to slow down or increase money flowing around the economy. Taxes are a big source of income for the government to fund programs. Taxes don't just include taxing people's income. They can also include taxing businesses, property, import taxes, and more. If governments have headroom to redistribute money into the system, they may lower taxes. Headroom, think about it like a pot. If they think by the end of the year that they have a larger pot to play with than they initially thought, they spent less than they should have, or they spent less because the economy didn't need it, they might use the rest of that pot to lower taxes because they can, they're able to do that. This is similar to what we've seen from the UK government recently, where they had extra money left over. As a result, they redistributed the money by lowering taxes. In this environment, the market saw this as a positive sign for future UK growth. And when all this was being announced, we saw a little bit of pound strength on the back of that because the market saw that, okay, this is going to be good for growth down the line. Maybe inflation slightly on the stickier side and the pound strengthened on the back of that. But overall, taxes are used to help manage aggregate demand, maintain global competitiveness. So for example, if a company spends less taxes in Dubai, like Dubai is a good example of that, or Switzerland, or Luxembourg. That's why you tend to see a lot of companies set up in like Dubai or Luxembourg because there's hardly any taxes there. So they're trying to maintain global competitiveness by saying, if you come to our country and you open a company here, you are going to be spending less taxes, for example. And incentivize consumer behavior. Taxes are a big tool for a government to consider. Think of it like raising or lowering an interest rate. It requires significant consideration of what is happening to their economy whilst balancing objectives and interests. So they will look at the overall economy and say, "Oh, we're pretty weak at the moment. Our objective is to help support this sector over here. Okay, let's lower the import tax for that sector, or let's allow more money flowing through those companies, for example, so they're able to hire more and spend more and naturally just drive up that industry." So taxes are just another way of help money flow around the system. Not necessarily increase the money, because that's more of what the central bank will do. Just help money flow more freely around the system and less money going to the government, for example. So how do you apply a fiscal policy to FX? Applying fiscal policy to FX trade ideas is a little more nuanced. What we mean by this is to think about the future expectations of growth and what it means for the economy and inflation. If, for example, taxes are being lowered, that likely means better growth in the future and, as a result, likely higher inflation. So always think about the thought process going forward. Think about it as a longer term idea, trade idea. So it's not like you're going to say, "Oh, this country is lowering the tax over here. Okay, let me just buy that currency." What you want to be doing is applying it to the larger framework of what you are going to be doing, i.e., you're going to be focused on what the monetary policy is doing. You're also going to be looking at kind of the overall risk sentiment. If it's all supportive in terms of what the government is doing to growth, helping sort of the sectors and the industries, you got the central bank doing this over here, which is also supportive. That gives you like another confirmation, if you will. Think about like confirmations. Markets may go long the currency in this environment. However, if markets have already priced in such an event, it's not a viable way of expecting stronger currency. So if, for example, there's a lot of speculation, buying the rumor, for example, you might have heard this term, buying the rumor, selling the fact, buying the rumor into saying, the company or the government, shall we say, has bigger headroom, so they're likely to lower taxes. You might see the currency strengthen before the event, and when they announce it, that's them to exit. So buying the rumor and then selling the fact that that's actually happened, for example. Fiscal policy should be used as a longer term gauge rather than a shorter term trade idea. Couple that with monetary policy, and now you're in tune with both the government and the central bank policies. We'll speak about loose, so expansionary, and tight, contractionary fiscal policies in the next videos. So that's it for simply what is fiscal policy. We'll see you in the next videos.